this next one, now we're going to go into substantive testing because we kind of talked about controls the first half. The audit risk model, you remember the basic 3-step approach for using the audit risk model in the planning engagement? If you don't, look at the notes at the bottom, right? Remember that audit risk has to be set. What is it set at? Come on. Acceptably low, right? And then the auditor does what to the risk material misstatement? Do they set it? Do they calculate it? What do they do? They have to go in and assess it. What 2 risks make up the risk material misstatement? Inherent risk was one, and control risk was the other, right? And we said that control risk was always set at maximum at high, unless what? What has to happen for control risk to be assessed at anything other than high? Robert? Auditor has to test controls. That's the only way to set control risk other than high. Very good. And then detection risk is the one that's calculated, right? The plug, if you will. And that's the risk that's under the auditor's control, right? And detection risk helps the auditor set what? The net, nature, extent, timing, right? Very, very good. All right. So what's inherently risky about revenue and collections? What's risky about this? Assets, right? Assets and revenue being overstated. Liabilities and expenses being understated, and then omitting things you don't want people to know about, right? So what's inherently risky about revenue and collections? So there is some sort of motivation here, incentive to have this particular account be overstated. So in the notes, you'll see there are things like improper revenue recognition, because things like cutoff issues, billing and holding, channel stuffing, that's when they try to manipulate the sales to make it seem as though something was earned when it really wasn't, right? Like inflating sales, or trying to manipulate the allowances and returns, right? Things that would end up overstating revenue. So as we get into this chapter, remember that we defined what significant accounts were. We defined what relevant assertions were before the last exam. So in this cycle, what are the significant accounts? Accounts receivable are significant accounts, right? So for revenue, what are our relevant assertions? What are the assertions that the auditor deemed as the possibility of having a material misstatement in them? They're listed. What are they? Occurrence, completeness, and cutoff, right? That means that for each one of those, you're gonna have to know how to test for that. For accounts receivable, what are the relevant assertions? Existence, completeness, and valuation. We're mainly gonna focus on the completeness and existence part. But as a reminder, with revenue, occurrence is one of the relevant assertions. What is the key question with occurrence? What are we testing here? What was that key question I told you way back when to remember to set aside a whole page for assertions? Because we're gonna need that when we need it. What's the key question? Yeah, did the transaction happen? Did it actually happen? Did it occur? Very good. What is the key question with completeness of revenue? Right, is all the revenue recorded that should be recorded? Whereas with occurrence, really what you're worried about here is fake sales. Did those sales actually really happen, or did somebody just add in some revenue journal entries? Did those sales actually happen, right? And cutoff, what's the key question with cutoff in the revenue cycle? Are the sales recorded in the correct period, right? So that when question is going to be really important, because we're going to talk about, well, what documents do you need to know to determine when it should have happened and when it did happen? Very good. What could go wrong with each what's the risk associated with each relevant assertion? Well, when you're talking about occurrence of revenue, like I said, fake sales, right, is an issue. That is what can go wrong, right? Because there's an incentive to overstate. Completeness, what could go wrong? Same thing. Are all the revenue transactions recorded that should be recorded? Cutoff, are all the revenue transactions recorded in the correct period? So the problem with that is that they're not in the correct period, right? The problem with the key question for existence of accounts receivable is that the accounts receivable that are recorded on the books are fake. That's an issue. That's an existence issue. Or that not all the accounts receivables that should be recorded are recorded. That would be a completeness issue.